Why do you think so many schemes are being launched? Just because you are investing in more equity schemes doesn't mean you're diversifying more, because those schemes in turn are investing in only the same set of stocks. The moment you decide to invest in more than 5, 6, 7 schemes, you are essentially on the whole buying the same set of stocks.
Yeah, it's crazy. In India, we have something like more than 1500 schemes chasing the same 200 stocks. One fund that we wrote about recently, which is the Motilal Nifty Defense Fund. That one, the top 3 companies account for half the portfolio.
Wow. So it beats the entire idea of investing in a mutual fund. You might as well buy the stock.
Yeah. Hello and welcome to Moneynomics with Mint. This is Neil Borate, editor personal finance at Mint. And I have with me the industry's fiercest critic and greatest commentator, Vivek Kaul.
Thanks, Neil, for having me over.
You're welcome. Today we're going to discuss a term that the industry has been obsessed with, has been launching almost every week, NFOs.
New fund offers, yes.
New fund offers.
So I should tell you this, when I started off in journalism in the October of 2005, NFOs weren't called NFOs. They were called IPOs. So the term essentially used when a new equity mutual fund scheme was launched was an initial public offer. And that obviously created confusion in the minds of investors, because IPO is something that companies launch when they list their stock on the stock exchange for the first time. So that change happened, and I think the term NFO is now being used for close to 2 decades. So that's an interesting nugget that obviously the current generation has no idea about.
So what was the last NFO that you invested in, Vivek?
Oh my God, it's a great question. I think if my memory serves me right, Reliance had launched a small cap fund. It was a small cap fund, and it was also a closed-ended fund. And the reason they had launched a closed-ended fund is very, very interesting. What had happened was that Sebi had cracked down on all these NFOs being launched. I don't remember when this happened. This was probably in the 2000s. Sebi had cracked down, and they had said that when you launch a new fund offer, an open-ended new fund offer, the proportion of money that you could spend on advertising and stuff like that was limited. They had cut it to a certain amount. I don't remember the exact details. So the creative solution that the industry found was they simply started launching closed-ended funds. So one of the closed-ended funds that was launched was a Reliance Fund, and I essentially invested.
So this is Reliance ADAG, which is now Nippon.
Which is now Nippon. So that was, I think, to put in that disclaimer, I'm not even sure of the name of the fund. So, but it was a Reliance Fund, that I remember. So that was, I think, the last time I invested in a NFO. So it's been, and I think it was one of the few, or probably the only NFO I have ever invested in. And I don't remember why I did it.
You're a disappointment to the industry, Vivek.
Yes, I have never invested in an NFO, or almost never. So
same here.
Yeah. It's not, it just doesn't make any sense, because when, at least, the least that you can do before you invest in a equity mutual fund scheme is look at its past performance. Even though past performance does not mean that the scheme will perform well in the future, but at least it gives you some semblance of, how that scheme has done across a period of time. Whereas in an NFO, there is really no track record. So I don't know as to why people get so excited about the idea of investing in a new equity scheme. So
I think it's to do with in every other facet of life, right? We love novelty.
That obviously is true. It's also the same reason as to why people invest in PMS services, when a good equity mutual fund would fulfill their need of investing in stocks. Also, there is this old I don't know if it still happens, but at least in 2000s, when in the first decade of the century, when I would track mutual funds more closely than I do now, there used to be this rupees 10 thing, and it was very interesting that because when a mutual fund is launched, the a single unit is sold at 10 rupees, right? And obviously, as the fund, the money collector is invested, the net asset value or the price of a single unit keeps going up. So the distributors would essentially missell by using this very, which I find very funny now, technique that you will get more units when you buy a mutual fund. So the logic was that if you invested 10,000 rupees in a mutual fund, in a new mutual fund, you would get 1,000 units. I mean, I'm not taking any expenses into account here, but for ease of calculation. Whereas, let's say if you invested the same 10,000 rupees in an old mutual fund with a rupees 20 NAV, you
And
would
the
get
same portfolio.
and the same portfolio, you would only get 50 units. I mean, it was quite a stupid argument because let's say 1 year later, if both the schemes gave a 10% return, I mean, it's the 10% return you get, irrespective of the number of units they have. But people loved it. It's like how people invest in the dividend option, right? Because they think they are getting a dividend. I mean, a mutual fund dividend is very different from a stock dividend, right? Because the dividend that you get in a mutual fund is essentially your money being returned to you, wherein they actually sell the stocks they own and then they give you give you that money, and the NAV falls to that extent. So these are techniques that have thrived over a period of time. And but anyway, what I found pretty exciting while researching for this episode was that it reminded me of how things were back in 2005 when I joined journalism, and mutual funds were launching new equity schemes left, right, and center. So to just give you some data points, in when I joined a newspaper which is now defunct on October 1st, 2005. So I'll give you some data here. And as on 30th September 2005, the total AUM of equity mutual funds in India was less than 60,000 crores. And in the next 6 months, they launched 24 schemes, new schemes, which is on an average one scheme a week. And they raised close to 22,000 crores. So that was how huge. I mean, in absolute number terms, it doesn't sound huge, but if you look at it proportionately, it was huge.
Yeah, so almost a third, I think.
Sorry?
Almost a third.
Yeah, almost a third, and more than a third, in fact. So, and so I get that same sense of feeling of how things are happening right now. So why do you think so many schemes are being launched?
The answer is almost obvious. The fund management industry is able to charge a higher expense ratio on the NFOs because they are smaller schemes. Because the way that Sebi regulations work, the smaller the scheme, the higher percentage you can charge. So when your older schemes grow too large, your percentage limit of expense ratio comes down to a point where maybe you can do better by launching these offshoots. That's the real reason. The purported reason they give is that you can take a bet on this or that theme or sector, and they keep rotating the same names over and over again. Bharat, this, India, that, opportunity, that.
So I'll tell you, this reminds me of one particular launch which happened sometime again before 2010. I don't remember the exact year. And there was this large public sector mutual fund which launched a scheme, and I don't think I'll give the name of the scheme because then the mutual fund will become obvious. They launched a scheme where they said they will invest according to where the registered address of a particular company is. And they had done some back calculation and found that companies in the western and southern part of India do better than companies in the northern and the eastern part of India. I mean, which is like as obvious as anything can get, because some of the best companies are headquartered and /registered and or /registered in the
but hi-fi as a fellow western part of India person.
Yes. So that is how things used to be, where people would just launch the same scheme with a different name and sell it to the investors. In fact, the other funny story, I'm sorry I'm going out, I'm feeling very nostalgic today. So the other funny story that's going around in my head is that I remember writing a piece where we concocted names of new mutual funds that the industry can possibly launch. So there used to be this Tiger Fund, which is still around. And so the Tiger Fund was a success even at that point of time. And so in line with that, there were, other launches were planned. So one fund house planned a Lion Fund. One fund house planned a cup fund. So I said, what is stopping them from launching a monkey fund or like something like a snake fund? So the full form for monkey that we came up with was multiple opportunities in a new knowledge economy. So that was, those were the times you could possibly launch anything and get away with it. So Neil, enough of these nostalgic memories and fun and games. So I'll share some data now. So, during the course of this financial year, from April to June, 50 new equity schemes have been launched and they have collected around 43,464 crores. Last financial year, 167 schemes were launched and they collected close to 62,612 crores. So, during the course of the first 4 months of this year, more than two-thirds of the money that was collected in the last financial year has already been collected. I'll also share some more data on what kind of schemes are raising this kind of the huge amount of money. So from April to July 2024, 13 new equity schemes, which are sectoral or thematic schemes, were launched and they collected more than 33,000 crores. So basically, out of the 43,000 crores, 33,000 crores has come in through sectoral and thematic schemes. And the last financial year, 37 such schemes were launched and they collected close to 25,500 crore. So 25,500 crore of around 62,000 crore. So a good chunk came into sectoral and thematic schemes. So, what is happening here? Why are these schemes being launched? Why are they proving to be so popular with the retail investors?
So Vivek, if we take a step back, in late 2017, Sebi came up with the classification of mutual funds.
Yes, they did.
And it said that it laid down, certain number of categories of equity funds, of debt, of hybrid. And it said that a fund house can only launch one scheme per category. So one large cap fund,
one mid cap.
Yeah. So those were filled up. Now, question remains, now what to do? So Sebi had created some open-ended categories like thematic and sectoral where there was no such limit. So now that's the only thing that's left, and that's what they are launching. In fact, one fund that we wrote about recently, which is the Motilal Nifty Defense Fund, that one, the top 3 companies account for half the portfolio.
Wow. So it beats the entire idea of investing in a mutual fund. You might as well buy the stock.
Yeah. And it has a PE of about 66, which is 3 times the Nifty. Yet it got a fair amount of subscriptions. So
that's because defense has been a racy theme with investors, and they would have thought, instead of looking for multiple stocks, why not just invest in this scheme and get done with?
Yeah.
And that would have been the selling proposition of the scheme as well. So for all we know.
Yeah.
So basically, this proves all over again that more retail investors come into the stock market only once the stock market has run up quite a bit. And the intriguing thing here is, because I have a habit of looking for economic principles everywhere. The intriguing thing here is that this works exactly opposite to the law of demand. The law of demand essentially states that lower the price, higher the demand. I mean, at a very simplistic level. Whereas if you look at stocks, they tend to work in the opposite direction. The higher the price, the more the demand. I mean, the same is true about real estate as well.
So mutual funds work on the law of what is the past 1 year return. Higher the past 1 year return, more is the demand.
I think 1 year is also too long a time. I mean, now we are probably looking at 3-month returns, and
possibly,
for all we know, because obviously both of us are not mutual fund distributors, so we don't know for sure. So, so that is very, very, interestingly explained as to why people are lining up to invest in these funds. Now, what is the risk?
There are multiple kinds of risk. One is that if you put a very large amount of money in these kind of funds, then you will probably end up losing quite a bit, because they are risky by definition. They are not diversified. The other is that instead, if you just put small amounts of money, then you just end up with vast portfolios of funds, 30 funds, 40 funds. You can't keep track of them. And the research that's needed to, figure out if you should keep holding or not, is people don't do it. Why would you?
And also, people who invest in 30 schemes really don't understand this as well. So,
So that's the sort of minor issue, but also, over the long term, a problematic issue with having lots and lots of these.
No, and also if, let's say, the person investing in 30 schemes dies, then it becomes a problem. It's a huge problem. I mean, obviously we don't tend to think about death. when it comes to investing. So, talking about investing in many schemes, it reminds me of a pretty interesting example. Something that happened to me recently. A friend, a very good friend of mine, sent over his details of his investment portfolio, and I figured that he had invested in 30 different mutual fund schemes, and his wife had investments in 17 different equity mutual fund schemes, and these schemes were not common. So they ended up as a family investing in more than 30-35 different equity mutual fund schemes. So I found that quite crazy, and once I started looking through the portfolio, what I found out was that his investment advisor, if you can at all call that guy an investment advisor, had sold him practically every new mutual fund equity scheme that had been launched. And in his head, this guy, this friend of mine, thought that the more mutual fund schemes, equity mutual funds he invested in, the more diversification he achieved, which is something that a lot of people don't seem to get, that just because you are investing in more equity schemes doesn't mean you're diversifying more, because those schemes in turn are investing in only the same set of stocks. So, this essentially reminds me of a data point that a gentleman called Vashishta Iyer, who is the CEO of Chief Operating Officer of Capital Mind, had shared in October last year. And he said, of the 427 active mutual funds, 95% of the investment was in 382 stocks, and 80% was in 178 stocks. So basically, if we were to sort of simplify this, most of the mutual fund investment is in around 180 stocks. The moment you decide to invest in more than 5, 6, 7 schemes, you are essentially, on the whole, buying the same set of stocks. And all the arguments about the fact that investment styles are different and all that go for a toss, because at the end of the day, the investment style may be different, but if the fund managers are buying the same set of stocks, it doesn't really matter. You will end up getting the broader market return.
Yeah, it's crazy. In India, we have something like more than 1,500 schemes chasing the same 200 stocks. And there are more schemes than stocks, or at least actively traded.
So that actually is true about almost all markets. But the point is well taken. I mean, the gap in India is actually huge.
It's like that Hindi film कि मेरे पास बंगला है, गाड़ी है, म्यूचुअल फंड स्कीम है, तुम्हारे पास क्या है?
You should try working as a dialogue actor in Hindi cinema. They can probably do with you, and you'll obviously make more money as well. So what should investors do?
They need a Marie Kondo moment. They need to clean up that closet, for which they need a good registered investment advisor who can do that cleanup. If not, if you really are hard up for money, can't pay a fee, there are websites. Value Research, for example, does a good job with telling you what the overlap is if you upload all of your schemes onto there, and you can cull out the ones that aren't really adding value. But
so, is this free, or
it's a free tool that they have?
Okay, so it's a great free tool to use.
Yeah. But it has.
So hold on. But this is an interesting point. So let's say I have 15 mutual fund schemes. Okay, so I log on to this website, Value Research, and I put in the names of these schemes.
Yes.
Right, and they will sort of analyze and tell me that what is, which are the stocks which are common across these schemes.
Yes.
So that will give me a sense of the fact that there is no point in having these many schemes.
Yes. Okay. And so, for example, you have, let's say, consumption fund, but 60% or 70% of its portfolio is the same as a Nifty index fund or the same as any large cap fund. Then it's not giving you anything more.
Right. So when you talk about consumption, it essentially reminds me of the fact that all these themes, consumption, innovation, business cycle, special situation, you can name them whatever, and then you can invest in
tiger, monkey.
I mean, in the same. I mean, Tiger Fund at least has some.
So it has an interesting history because DSP Mutual Fund, which launched that scheme, did a recent presentation on it. So the history is that from 2008 to, if I remember correctly, until 21, that fund, or rather until 2020, it gave a 0% return because the pandemic wiped out all of the gains that it had made.
Wow.
Not that it had made a lot of gain after 2007. Whatever it had made, it got wiped out. And then in the post-pandemic bull market, that the one we're in currently, it roared back to life. The tiger roared back to life. So they were trying to illustrate the point that, look, you have to be prepared for many very long periods of no return. But I would say that it's all very well to know that in theory, but in practice,
And in hindsight.
yeah, and in hindsight.
Right.
But when people see 2-3 years of no returns, they get out and you get out at a loss.
So which is again, it takes us back to the point that why it essentially makes most sense to stick to larger, to index funds which essentially invest in the broader market and not get stuck up with sectoral funds.
Yes.
Or you can have exposure to sectoral funds, but that cannot be your primary investment. It can be the icing on the cake and not the
Yes.
cake. Or it should at least.
Yes, so I have a slightly different outlook to
Sure.
you, which is I prefer actively managed flexi cap funds. I still believe there's a little bit of alpha on the table that one can grab.
Okay, so
And-
hold on. What is alpha? Because
Right, so alpha is
alpha, beta.
so alpha is outperformance over the index,
Okay.
which a good fund will do, is supposed to do. So
We also need to tell our viewers here that most funds don't,
most funds don't. Yes,
which is why you should stick to index funds. Sorry,
so yeah, that is the
this is the
classic-
logic which is offered.
Yes. So I think that instead of investing in sector and thematic funds and NFOs, a good flexi cap fund will get you those exposures anyway.
Right.
And it doesn't make sense to then have 10, 20, 30, 40 funds. A few funds will get you that same exposure.
Exactly. Also, what another point that our listeners need to know about is the fact that when you launch schemes with names like consumption, business cycle, innovation, special situations, so fund managers can make investments and then with some English they can justify anything, right? So
Yeah.
it's not like consumption is okay, but consumption will anyway benefit a large number of stocks.
Yes.
So, I remember this interesting example, and again, my memory might be playing tricks here, but I had read it in a book that the late Parag Parekh wrote, and he had talked about how an IT fund, which was supposed to invest in information technology stocks, had invested in Hindustan Unilever. And, obviously mutual fund rules are flexible to the extent that they allow you to do that. Like in the recent past, we do know of a small cap fund which had top investments in Reliance and HDFC Bank. But then, as for a retail investor to know about all these things is also not
It's a
possible.
tall order.
It's not. I mean, you are cued in, so you know. I mean, I am sort of partially cued in, and if I am not cued in, I can call you. But the retail investors do not have that kind of, access to information. And I'm simplifying things here. Is that most retail investors should stay away from new equity,
New fund
launch,
offers.
new fund offers, right? Okay, and I would also like to make because I've been making all these nostalgic.
Vivek, there's one caveat to that. Though.
Okay.
There are some new fund offers that have to come because the tax system has changed.
Fair enough.
And you need to redesign the fund to optimize for tax.
Fair enough. So that
So-
makes sense.
Yeah. So in the past few budgets, we have situation where debt funds went into slab rate taxation regardless of holding period. Then they carved out the funds that were investing in neither debt nor equity. If they were doing overseas stocks or if they were doing gold, then those got to carve out. Fund of funds got to carve out. So now you can actually design a tax efficient debt fund, which the industry has not yet done on the scale that it should. So I'm looking forward to
So you are basically applying for a product manager job at a mutual fund.
if they will have me.
Okay. So, I think one final point that I wanted to make, and because I've been making all these historical nostalgic points, so I would like to talk about the year 2007, 2008, when the launch of new fund offers sort of peaked. I mean, I'm obviously talking about, a period which is 17, 18 years back. Now, I remember that during that year, because there were so many mutual fund launches, one was at a 5-star hotel attending a press conference for the launch almost every week. And there were 55 launches during the course of that year. And those 55 schemes raised a little more than 43,000 crores. Okay. Which again doesn't sound like a lot of money now, but it was a huge amount of money back then because we are talking about almost 17, 18 years later.
And all of these launches actually make me gain so much weight It's always
So, which is what would happen, because we would obviously not go there for a launch, because we knew that the fund manager
we would go there for the lunch.
would BS. So we would go there for a lunch, and the lunch also, over a period of time, the lunch also became boring. So you were like, before you went, and I don't know if I should say this because it doesn't make me look good. So then you would try to confirm with the Copcom guy or the PR guy as to
खाने में क्या है?
खाने में क्या है. So not my best behavior. But so what I was saying is that 55 new schemes were launched and more than 43,000 crores were raised. Now I have a question for you. How long do you think it took the industry to raise the same amount of money that it did in 2007-2008?
3-4 years?
Actually, it took them more than 9 years.
Wow.
So between April 2008 and June 2017, 268 new equity schemes were launched, and only then did they manage to raise a little more than 43,000 crores. So they raised around 44,000 crores. So over a period of close to 9 years and 3 months, in fact 9 years and 3 months, the industry launched 268 new schemes, and then the total amount of money they raised was more than the money they had raised in just 1 year when they had launched just 55 schemes. And why do you think this happened? And this happened because all these schemes which were launched in 2007-2008 were launched when stock prices were at peak levels. So in January 2008, the BSE Sensex peaked at around 20,872 points, if I remember it correctly. And then it fell, and it fell like big time. And after falling, it recovered, but it sort of took many years to get back to where it was. And what happened was that this put off many investors, because again, you had come in and invested at the peak. So I think this is something that retail investors need to keep in mind.
Yes.
That the good story does not always continue. So Neil, I had sort of written a line to summarize this entire discussion that we had. And this, in a way, represents the retail investor and their state of mind. So Cinderella only gets worried after the clock strikes 12. Till then, she continues dancing. And the Indian retail investor right now is basically dancing.
That's very true.
Yes. So thank you for listening to us, and thanks, Neil, for giving us all the gyan that you did today.
Where's my commission for it?
Okay, commission we'll talk off the camera. We'll do it in cash. So.